Welcome to today's video on the Spousal IRA opportunity. How a household with one earner can legally fund two individual retirement accounts. We will unpack the rules, the common traps, and the exact steps to implement this without triggering costly tax problems. First, let's outline our roadmap so you always know what comes next. Here's our agenda. We'll begin with why this provision exists and who qualifies. Next, we'll cover eligibility, limits, and the crucial warning about keeping rollover IRA money separate. After that, we'll introduce the Backdoor Roth and explain when it's necessary. Then we'll walk through an action plan, analyze a case study, and reinforce learning with quizzes and key takeaways. Finally, we'll wrap with a summary and your next steps. This presentation is for educational purposes only and does not constitute tax, legal, or investment advice. Your circumstances are unique, and IRS thresholds change, so you must verify the latest IRS rules or consult a qualified professional before acting. With that foundation, let's move into why this opportunity exists. Spousal IRAs exist to help couples build two independent retirement nest eggs, even when one spouse does not have earned income. If you are married and filed jointly, the working spouse's earned income can fund both spouses' IRAs, subject to annual limits and eligibility rules. This is often called a spousal IRA, but the account itself is just a standard IRA owned by the non-working spouse. Now, let's visualize how to choose the right path based on your eligibility. This flowchart shows the decision path. First, confirm that you are married filing jointly and that at least one spouse has earned income. If either condition fails, the spousal IRA route is not available. If both are met, open a separate IRA owned by the non-working spouse. Next, assess whether your modified adjusted gross income is within the Roth limit. If yes, contribute directly to a Roth IRA for simplicity and long-term tax-free growth. If your income is too high, check whether you qualify for a deductible traditional IRA. If not deductible and your income blocks direct Roth, the fallback is a non-deductible traditional contribution followed by a prompt Roth conversion, known as the Backdoor Roth. Throughout, keep rollover IRA assets separate to avoid the pro rata rule complications during conversions. Now that you see the decision framework, let's anchor the specific income thresholds. As of the 2024 tax year, the Roth IRA contribution phase-out for married filing jointly is from $230,000 to $240,000 of modified adjusted gross income. For traditional IRA deductions, if you are covered by a workplace plan and filed jointly, the deduction phases out from $123,000 to $143,000. If you are not covered by a workplace plan but your spouse is, the deduction phases out from $230,000 to $240,000. These figures can change, so verify current IRS limits before contributing. With the limits in mind, let's address the most expensive mistake people make with spousal IRAs. Never mix new annual contributions into an existing rollover IRA that holds pre-tax funds from a former employer plan. Doing so commingles pre-tax and after-tax basis. If you later attempt a backdoor Roth conversion, the IRS pro rata rule will aggregate all of your traditional, SEP, and simple IRA balances when determining the taxable portion of any conversion. This can create unexpected taxes and tracking complexity. The best practice is to keep rollover IRA funds in a distinct account and open a fresh IRA dedicated solely to your yearly contributions. Next, to help you see the overall decision structure at a glance, let's map the strategy. This mind map centers on the spousal IRA strategy. The accounts branch distinguishes a rollover IRA, which must remain separate with no new contributions, from a contribution IRA that receives annual traditional or Roth contributions. The income limits branch emphasizes magI thresholds, phase-outs, and the need to verify figures each year. The Backdoor Roth branch highlights the steps, the impact of the pro rata rule, filing Form 8606 to track basis, and potentially rolling pre-tax IRA funds into an eligible employer plan to isolate basis. The risk management branch covers converting quickly to limit gains before conversion, timing, and keeping documentation. Now, with the strategy structured, let's turn it into concrete steps you can follow. Start by confirming that you are married filing jointly, and that your household has enough earned income to support the desired contributions. Next, check the latest IRS magI limits and deduction rules. Then open accounts correctly. Keep any rollover IRA separate and open a brand new IRA exclusively for annual contributions. Decide on the best account type. Use Roth if you are within the income limits. Choose a deductible traditional IRA if eligible. Or, if neither is available, use the Backdoor Roth by making a non-deductible traditional contribution, filing Form 8606 to record basis, and converting promptly to Roth. Automate monthly contributions and label accounts clearly to avoid accidental mixing. Finally, document your steps and review annually to stay aligned with changing rules. With the steps in place, let's visualize the Backdoor Roth flow so you can execute it precisely. This sequence illustrates the Backdoor Roth. Household earned income funds a non-deductible contribution into a brand new traditional IRA. You must file IRS Form 8606 to record your after-tax basis. Convert to Roth promptly to minimize any pre-conversion gains that would be taxable. If you own other pre-tax IRA balances across traditional, SEP, or simple IRAs, the pro rata aggregation rule determines how much of your conversion is taxable, which is why keeping rollover funds segregated or moving them into an eligible employer plan when possible can be so valuable. Now that you've seen the mechanics, let's test your understanding with a quick quiz. Quiz time. The question is, true or false? It is fine to add your new annual contribution into your existing rollover IRA if you label the deposit clearly. Option A is true. Option B is false. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is false. You should never add new annual contributions into an existing rollover IRA. Mixing funds triggers aggregation and pro rata complications if you attempt a backdoor Roth later. Keep rollover funds isolated and use a separate, clean IRA for annual contributions. Moving forward, let's compare direct Roth contributions with the backdoor route. On the left, direct Roth contributions are straightforward if your modified adjusted gross income is within the IRS limits. You contribute directly, avoid basis tracking, and enjoy potential tax-free growth and qualified withdrawals. On the right, the backdoor Roth involves contributing non-deductible dollars to a traditional IRA and then converting to a Roth. It requires filing Form 8606 and managing the pro rata rule. The backdoor is ideal for high-income households that exceed the Roth limits but still want Roth exposure. Now let's solidify this with a condensed case study that uses Markdown to emphasize the numbers and decisions. Consider a married filing jointly household with one earner and modified adjusted gross income of $228,000. In 2024, the Roth IRA phase-out for married filing jointly is $230,000 to $240,000, so they are currently eligible for full Roth contributions. They plan to contribute $7,000 to each spouse's Roth IRA, totaling $14,000, assuming both are under age 50. If their magI later rises to $235,000 during the year, they should pivot to a partial Roth contribution per IRS limits, or instead route additional dollars through the backdoor Roth. Throughout, they keep any old 401k rollover assets in a dedicated rollover IRA and open a separate, clean IRA if they ever need to make non-deductible contributions for the backdoor. Finally, they monitor magI projections quarterly and adjust automated contributions to avoid excess contributions. Next, let's do a second quick quiz to confirm the role of income limits. Here is your next quiz. Which statement is most accurate for high-income married filing jointly households over the Roth limit? Option A says to contribute directly to Roth because income limits do not apply to married filing jointly. Option B says to make a non-deductible traditional contribution and convert via a backdoor Roth while monitoring the pro rata rule. Option C says to skip IRAs entirely because there is no legal workaround. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is to make a non-deductible traditional IRA contribution and then convert via the backdoor Roth while monitoring the pro rata rule. This approach is explicitly intended for high-income households that cannot contribute directly to a Roth IRA. Ensure rollover IRAs remain separate and file Form 8606 to track basis. Next, let's capture the essential do's and don'ts as key points. Key do's and don'ts. Use household earned income to fund two IRAs when married filing jointly. Verify magI and deduction limits each year. Keep rollover IRA funds separate and do not add new contributions to them. If income blocks direct Roth contributions, use the Backdoor Roth and file Form 8606 to record basis. Do not ignore the pro rata rule, because aggregated balances can create unexpected taxes, and avoid unnecessary delays between contribution and conversion to limit taxable gains. To close the loop, let's summarize the journey and your next moves. To summarize, a spousal IRA is simply a standard IRA funded by joint income when you file jointly. Always check your modified adjusted gross income thresholds before deciding between Roth and traditional contributions. Never mix new contributions into a rollover IRA. If income blocks direct Roth or deductible traditional contributions, use the Backdoor Roth and file Form 8606. Finally, automate contributions, document steps, and review annually. Before we close, here's one more quick visual cue to reinforce timing across the year and key checkpoints. This timeline outlines an annual rhythm. From January through April, set your contribution plan and confirm accounts are clean and separate. From May through August, monitor your modified adjusted gross income and adjust contributions accordingly. Between September and November, recheck your projections and consider rolling pre-tax IRA assets into an eligible employer plan to isolate basis before any backdoor Roth. In December, finalize current year contributions. Finally, from January through April of the next year, complete any prior year contributions before the tax deadline and file Form 8606 if you used the Backdoor Roth. Now, let's close with a call to action. Thanks for watching. If this helped you avoid a tax headache, please like the video, share it with someone who needs it, and subscribe for more practical strategies. Post your questions or your own spousal IRA tips in the comments. We read every one and might feature your scenario in a future video.